Greetings, everyone. This is Caroline Staten with Transition US, and thank you so much for joining our online event today. Our aim in the offering of these events is really to provide some practical support and knowledge to the leaders of transition initiatives around the country and in other countries, and those mulling over starting an initiative, and also community leaders really everywhere that are working on resilience building within their communities. And we would like to continue to offer these teleseminars at no cost, but do ask that you really consider making a donation. That's what keeps it all going. We have a donation button at the top of our website at transitionus.org. So thank you so much in advance to those of you who are able to do this. And now I'm going to introduce our presenter today and the topic. So the topic that Marco Vangelisti will be covering today, again, it's the third in the series. The first one was financial system and local investing, and this one is money and banking system. And currently the money and banking systems are conflated. Money is mostly created as debt by the banking system, and their very design demands continuous economic growth and an ever-expanding level of debt, both public and private. There is very little understanding in the general public about what money is, how it works, how it is created, and how the banking system operates. Only a fundamental shift in the design of the monetary and banking systems will allow for a viable way of addressing increasing inequality, the mounting problem of public and private debt, and make possible a shift towards a sustainable, steady-state economy that works for everybody and is compatible with environmental stewardship and really with this whole resilience and transition movement many of us are a part of. So about Marco Vangelisti, our presenter of this three-part series. Marco came to the U.S. from Italy as a Fulbright scholar in mathematics and economics at the University of California in Berkeley. And after a stint in the financial industry, Marco worked as a visual artist on a full-time basis for 5 years and obtained an MFA, focusing on the intersection between public art and ecology. He later worked for 6 years for Grantham Mayo Van Otterloo and Company, LLC, managing investment equity portfolios primarily on behalf of large foundations and endowments. And in April 2009, Marco left the finance industry and has since been instrumental in the formation and development of the Slow Money Northern California chapter, where he currently leads the Investor Working Group. And he's developing essential knowledge for transition, a whole curriculum for engaged citizens to understand the money and banking system, the economic system, and the financial system, and how we need to transform them. And Marco's also helping communities increase their capacity for local investing. There's a lot more information, a lot of resources on his website, which is EK4T, so Essential Knowledge for Transition, so EK4T.com. So without further ado, I'm so delighted that you're with us again, Marco, and look forward to this engaging and dynamic presentation. So over to you.
Oh, thank you, Caroline. I'm very excited to be here for the second installment. As the name of the program indicates, I developed this for the transition movement. I attended with Caroline a training for transition leaders in February of 2012, and I realized that the transition movement had recognized economic instability as one of the problems that require a resilience response at the community level. And I also realized that the movement could benefit from a better understanding of how the economic system works. So that will actually be the last part, which is next month we're going to be talking about the economic system. But as I was studying the system, I also realized that if we don't understand how the money and banking system works, it's very hard to fix the economic system. And finally, since I spent 20 years in finance, I also recognize the importance of understanding how the investments are shaping the economy and the world we live in. Okay, so let's get started. Page 2, I hope you have the PDF with you, otherwise you can find it online at the registration link. I want to start with what's possible. In other words, I will take you through some hard material to take in because as you might have guessed, the money and banking system is set up in a way that can be very damaging, and sometimes taking in that information is hard. So if anything that I share is hard to take in, take a deep breath. But I wanted to start with what is possible after we fix it so that we have an idea where we are heading. I will also mention what is the motivation for me talking about money and banking that seems such an abstract concept. And then I will just give you the highlight, the punchlines for what you need to get out of it in 5 minutes. And then we'll go into more details, the definition and brief history of money. We need to understand money creation, who creates money, what are the incentives for doing that. And then we'll look at the design, the system design issue of the money and banking system, and how that has caused a number of crises, and how the public and the government has been called upon to rescue the banks from their own mistakes. And finally, we will look at the systemic solution and the new possibilities. So there's a lot of material. And I also want to touch upon what I explained at the beginning of the last webinar, but I'm not going to repeat it. You can find it online, obviously. But slide 3 is basically the big framework for understanding the systems, that at the end of the day, we live on a limited planet, and this is the largest system that determines the limits and boundaries within which all human activities occur, which means that the social system, whatever we do in terms of culture, art, politics, and so on, has to recognize that there are some limits imposed by the biosphere, and we need to live within those boundaries. And similarly, the economic system is something that we as a society create, and we can set the boundaries and the desired outcome of the economic system. And finally, money and banking and investments are part of the financial system, and their role at the end of the day is to serve the economy, either by facilitating economic transactions or by allowing for investments for expansion of economic activity. And the problem is that, as you might imagine, we are not abiding by this hierarchical structure of systems. We have the financial system that grew too fast and too big and actually screwed up our economy. And it seems a little bit like the economy is running our society now as opposed to the other way around. But again, to go a little bit more in depth with this, just refer to the recording of the webinar I gave about a month ago. Now, the new possibilities once we fix that page 4, once we fix the money and banking system, are really great. I mean, we know that we need to do a lot of expensive investments and tackle a lot of issues that are going to be expensive collectively, right? We need to rebuild our infrastructures that are crumbling in this country. 70,000 of the bridges in the United States are structurally deficient. We also know that we need to improve the education system. We need to improve the healthcare and prevention for the aging population. We need to educate the young without having them pay through the nose and then end up with massive unrepayable student debt. We need to start thinking about climate adaptation, environmental restoration, to restore the environment for the future generation, and we need to rebuild the local food system infrastructure and repopulate new areas, rural areas, and transition to organic agriculture. All these projects require a lot of money, and how can we finance those without increasing taxes and without getting farther in debt? It will be possible once we tackle and redesign the money and banking system, and I will show you how to do that. So let me get into the motivation for why I'm speaking about this system to transition people who tend to focus on what is the project we can do now in our community to prepare for the challenges we face. And my take is that we need to do both. We need to do this this project at the local level to build a community and social ties and prepare for things, but we also need to look up and see, look at the big picture. And the way I see it is our society is running on, an economy is running on a faulty operating system. The money and banking system is like an operating system of society, and it's faulty. And the design of the money and banking system is directly implicated in a lot of the largest problems we face, like increasing level of debt, economic instability, concentration of wealth, loss of democracy, and environmental and climate disruption. And I hope I will show you the direct link between how the money and banking system is designed and these large problems that we're trying to collectively tackle. And the second slide of the motivation on page 6 is that we cannot solve a lot of the problems that we're really passionate about if we do not redesign the money and banking system. And prior to the next banking crisis, which will happen, we need to have a correct understanding of the systemic problem, a wide awareness of the systemic solution, and a political movement demanding its implementation. We actually had a chance to fix the money and banking system in 2007, 2008. We had that opportunity, but not enough people knew what the problem was and what the solution was. So I'm trying my best to get the word out. So I'll give you the punchline, and then I will justify what I'm saying. One of the things that very few people understand is that with the exception of the metal coins in your pockets, all money is created as debt. In fact, the paper money we use, which is issued by the Federal Reserve, requires on the books of the Federal Reserve a corresponding amount of U.S. Treasury debt. And it's true that the central bank cannot directly buy the Treasury bonds, but basically for every paper money in circulation, there is a corresponding amount of government debt held at the Federal Reserve. And 95% or more of our money supply is actually created by the private banking sector when they make loans with accounting entries. And I will actually show you the bank accounting that creates money. In other words, most of the money we use, which is electronic money, is originally created out of nothing with accounting entries by the private banking sector when they make loans. This fact has a couple of consequences. One is that we do not have a permanent money supply because when loans are repaid, the electronic money corresponding to it or used to extinguish that debt is eliminated from the system. So the more we repay the debt and the more we shrink the money supply. And the second problem is that the banks decide the first use of the money they create when they lend it into existence. And as you know, in the last 10 years, banks have loaned a lot into the real estate market in mortgages, and all that money that they created in corresponding to those mortgages has inflated a real estate bubble up to 2007. Obviously, that bubble has imploded, and now they are reflating it again. But this time, they're actually lending to hedge funds and other financial entities for them to buy the foreclosed homes and so on. And so, but it's the same process. They're reflating another real estate bubble. And the same thing is happening with the stock market too, because a lot of the lending of the private banking sector is going to support financial speculations. The second point, which is really the key design flaw of the money and banking system, is that only the principal of the amount that is lent is created as electronic money, but no one within the system ever creates the money to repay the interest on that debt. You know that if you take a mortgage, let's say $500,000, over the course of 30 years, you're going to be returning the $500,000 to the bank, but also all the interest, and that could be as much as twice as the amount that you borrowed. And no one within the system creates the money to repay the interest. In other words, there is a fundamental scarcity in the money system. Somebody will have to default on their debt eventually because there isn't enough money in circulation to repay all the debt. So there is more debt outstanding than there is money. And that was the joke of that comedian in the last video that we sent. And he was making, a joke about, oh, maybe we need to borrow from Jupiter because we have more debt than we have money on this planet. This, though, if you can see it, forces us to grow our money supply next year. In other words, to borrow more, and this implicitly forces us to grow the economy next year. So one of the drivers of economic growth is that if we can say that the economy is growing and therefore we need to borrow more, that keeps the game going for a while, because next year you need to borrow not only the money to repay the principal from last year, but also the interest for which no money was ever created. So this very design flaw is one of the reasons that we're forced on this continuous growth path for the economy. And the second one, which ties into environmental challenges, is that if you have more debt than money, one way to address that is to take something that is provided for free by nature and convert that into money. If a farmer cannot pay the loan back and has a piece of forest, he can cut down the forest and try to meet its debt obligation that way. So in other words, this very design system of the money banking system forces us to convert natural capital into financial capital, and also at the end of the day converting relationships into services. To understand that, think about the fact that most of the child care and food preparation 100 years ago required no exchange of money. It was done as part of the relationships within the community. The third point is that the private banking sector now has the monopoly on money creation. So over the course of the last couple of 100 years, government has ceded a key government function, which is money creation, to the private banking sector. And now when governments do not collect enough taxes to pay for goods and services that they offer their citizens, they need to borrow the money, right? A lot of people think that the government creates the money, but if that were the case, then the government wouldn't need to borrow. And so who does the government borrow from? It borrows from the people that have a lot of money and those to whom it ceded the power to create it, which is the private banking sector. This, by the way, explains, some of you have seen Inequality for All and know the issue with the increased inequality in wealth in this country. This very design of the money banking system explains in large part why that wealth inequality keeps increasing. Because effectively, if all the money is created as debt, that means all the money we use is on loan. In other words, we are paying every year in interest for the use of the money supply. And that interest is a tax on the productive economy that goes to the people that owns the assets and own the wealth, and to the banking sector that can create that money. That is basically a continuous extraction from everybody, 90% of the population, 95%. And the interests are flowing to the people that have the capital or can create it through the lending process. And the fourth point is the money is really an agreed upon fiction at this point. Most of the numbers you see in your checking account are just computer numbers. And they're only as real as the assets of the banks, and we'll talk about that. And finally, the debt-based money system, because it is structurally unsustainable, is now in the process of collapsing. And you're seeing that in Europe with Greece and Spain and so on. And any attempt, that's by the way why austerity does not work. When you're trying to shrink the debt of the government, what you're doing is you're shrinking the money supply, therefore contracting the economy faster than you're contracting the level of debt. And so austerity does not work. We need to go the other direction. And I guess the next cartoon on page 8 is basically we're on the same track. This money banking system where money is created by the private sector, no money is created to pay for the interest, is getting us towards a disaster, an economic disaster, and we're on the same track as Italy, Spain, and Greece. So that would need to change. So let me talk about the key questions that you need to ask when people are talking about money, and we will answer some of this today. Who creates money? By what authority? That's slide number 9. Who capture the seigniorage? The seigniorage is basically the difference between the cost of producing money when it is fiat currency and the face value. If you look at a $100 bill in the United States, it costs about 5 cents to print. And so the question is, who gets the privilege to pay 5 cents for that piece of paper and buying something that is worth $100? It's an important question to ask. What is money backed by? Who benefits and who bears the risk? Who controls the quantity of money? And what incentives drive money creation? So those are hopefully the questions we'll be able to answer. And let me move on to a definition and brief history of money. When people say, what is money? And the answer is fairly simple. Money is a commonly accepted means of exchange. It's something that people accept in exchanges for goods and services. And its primary function is to facilitate economic transactions. And over time, page 12, humanity has experimented with different types of money, commodity money, representative money, and fiat money. So I'll just give you a sense for what those are. On page 13, commodity money is basically a means of exchange that also have a value in themselves. So they can either be used directly or they can use to trade with others. So, in the past we used arrowheads, salt, nails, gold, silver, diamonds, and so on. Now, on page 14, representative money is basically usually receipts of commodities or of something of value. So, for example, gold receipts are an example of that, or the U.S. dollar prior to 1933. You could exchange $20.67 for 1 ounce of gold prior to 1933. So effectively, the U.S. dollar was a representative money because it represented a certain quantity of gold. But now we are in a fiat money environment, page 15. Fiat comes from Latin that says, let it be. And it's basically just an agreement. It is usually a piece of paper or an agreement that does not have a corresponding underlying value, although it derives its value from the fact that other people will accept it as a means of exchange. So your $100 bill has some value because you can get a $100 bill worth of things, but it's not tied, it's not a receipt of something of value. And so I will mention a couple of the fiat money that we used in the past. And by the way, the dollar became a fiat currency in August 15, 1971, when Nixon closed the gold window. Let me talk about a couple of them. But before I say that, there are 3 ways a sovereign government can issue fiat money. And remember, fiat is just made up money, right? It's just paper, usually. It can spend it into existence. So the Romans had brass coins. They were worth nothing in terms of material, but they had a value that was stamped on it. And by issuing that money into existence, they actually spent it and built, the Colosseums and the aqueducts and so on. The tally sticks in England have been around for 700 years. I will talk about them briefly. And I'll talk about the Continentals and the greenbacks, which we used in the United States. The second way a government can issue money is by lend it into existence. And I will talk about the Colonial Scrip in Pennsylvania, which is, I think, the best design in terms of government-issued money. And the third one, which I would argue is the least smart way for a sovereign government to issue money, is to borrow it into existence, like the U.S. and most modern governments are doing now when they have a private central bank. So just give you a sense for the tally stick, page 17. These were basically receipts for services issued by the king, and he would just carve some sticks, and they would circulate as currency, and they would be accepted for payments of taxes. So that's and they were around for about 700 years. It's a very interesting history, but there's an example of a fiat currency, just sticks that circulated, and to certain, I think in the 17th century represented about 80% of the money supply in the U.S. Sorry, in the UK. The Colonial Scrip is, I think, the best example of how fiat money should be issued. Page 18. The problem of the colonies in the United States is that they were using British money and they didn't have enough because the economy was growing, and the only way to get money from England was to obviously sell cotton or whatever other goods. But the economy was growing more than it could be facilitated with the amount of pounds or whatever the name of the currency at the time was from England. And so the colonies experimented with various ways of facilitating economic transaction by issuing fiat money. And in Pennsylvania, on March 2nd, 1723, the Pennsylvania Assembly issued 15,000 colonial scrips. They're just little pieces of paper. And what they did is they lent 11,000 into the economy at 5% interest. And they also spent 4,000 for public works and to pay for government administrative expenses. Now remember what I said, nobody creates in our system the money to repay the interest on that debt that issues the money in the first place. That was not the case. They solved that problem in Pennsylvania because they said, yes, we lend out 11,000 at 5% interest, but we're going to inject some more money into the economy to pay those interests back. And that is the 4,000 that was financing basically the operation of the government and the Commonwealth expenses. And the other smart thing they did is that they did not lend out more than 100 scrip to each individual person. They didn't want the rich merchants to get even richer. They wanted the poor and entrepreneurial people to get a chance. And this worked quite well. In December, slide 19 of the same year, they decided to issue another 30,000. They loaned 26,500 out at 5% interest, and they spent another 3,500 for government expenses. Now, when people say if the government issues paper money, we'll have hyperinflation, the answer is that's not necessarily true. In fact, this is a clear example where the proper issuance of fiat money by the government does not increase the level of prices if that money is given to people that are creating new goods and services. In fact, the period between 1721 and 1775 was the period with the most stable prices in any period of the same length in the history of the United States. So page 20 is just a picture of some of these scripts and some of these Continentals. And the last time the United States issued debt-free money was when Lincoln instructed the U.S. Treasury to print greenbacks. They were called greenbacks because they had a green back, and it signified that they were not associated with debt, nor they corresponded to gold. But the government accepted them in payments of taxes, and that made them good and accepted as a means of exchange. And we financed the war with the South by issuing greenbacks. That was the last time we had actually a permanent money supply in the United States. So people are recognizing more and more the problem with the current money system. On page 22 is a great book if you want to learn more about how the money system works and what we need to do to fix it. It's Modernizing Money by Andrew Jackson and Ben Dyson at the Positive Money Institute up in London. You can order it online from their site. And the sovereign money proposal is, again, this proposal for governments to reclaim the key government function of money creation and taking it away from the private banking sector, basically, which is also called the Revised Chicago Plan. And Michael Kumhoff, which is a researcher at IMF, has put out a couple of papers on this proposal. So maybe I'll open up for a couple of quick clarifying questions at this point. But Caroline, are there any questions at this point?
Well, I had neglected to tell people, but if you have a clarifying question during the presentation, press 5 on your keypad. and we'll have another session in a while where there's just more Q&A in general. But just clarifying questions right now, something that you're just not following, and we have a couple. Stuart Scott, go ahead.
The clarifying question is not about the content as much as I only found out about this series yesterday. I'm in on the call, and it's very valuable in the work I do, which is presentations internationally. But how can I get hold of the prior material? That was not indicated yet. And will will both of these sessions, or all three, if there are actually three, will they be available as media that I can then popularize, transmit, tweet, Facebook, whatever, present?
Absolutely, yes. So the answer to your question is yes. I do have a YouTube channel. So if you find me on YouTube at Marco Vangelisti, you'll find it. You can also find the recording of the last webinar on transitionus.org. If you go, there's a tab called Training, and then the Training Archive. And so you'll find it there as well.
Great. And there'll also be the recordings of this and the next event in those places, as Marco indicated as well. David Banner, go ahead.
Yes, thanks, Marco. I guess I'm thinking about the political will or political muscle that would be needed to take away the power to produce money through debt from the private banks, i.e. the Federal Reserve, and give it back to the government. How in the world could that happen, realistically?
Right. And I mentioned we had a chance in 2007. You know, the government actually bought the banks. They had to inject capital to buy them. If enough people knew about what was going on, we would have put pressure on them to say, let's keep them and run them as utilities for the interest of the public.
Right.
You know, so in other words, the opportunity will present itself next time the banking system will collapse and the taxpayers will be asked to pony up trillions of dollars to build them out. And by that time, I hope that enough people understand that there are alternatives and that we need to seize the opportunity when the banking sector collapses the next time.
I don't mean to be cynical, but the 1% of the people that are controlling what's going on are not likely to give it up without a, how shall I say, without a fight. In other words,
well, you know, as I said, I mean, right, no, I understand. And I mean, our take is either to say, I think we lost, they won, we're just going to be serfs in this economy, right? Or we can say, no, we're not done yet. And we're going to organize, we're going to learn about it, we're going to get involved so that when the opportunity presents itself, we have a shot. And that's the take I'm following.
Thank you, Marco.
Anyhow.
We have one more. Alice and Sarah, go ahead.
Yeah, this is Alice Leibowitz. My question was about the content. You said that it's sort of conventional wisdom that if the government prints paper money that it creates inflation, but it didn't happen with this Pennsylvania currency. Now why is that? Can you explain again why?
Yeah, so because
what was in the structure that made that not happen?
Right. So basically, if you create new money, but you lend it to people, so inflation happens when you have more money than goods and services in circulation, right? So if you create more money and the level, the set of goods and services is the same, all you're doing is increasing the prices of those goods and services. In other words, you're creating inflation. But if you lend money, if you're creating money and you're lending it to people that create new goods and services, and that's exactly what they were doing. They were lending it to small entrepreneurs that were creating goods and services. Now you have more goods and services to absorb the new money that you put in circulation. And so it's really a function of issuing money in a way that creates new goods and services, and it's proportional to the amount of economic transactions that you're trying to facilitate. And in fact, it will become more clear as they go on. And I just realized I'm getting a little bit nervous about how much I want to cover and the time. So maybe
there was one other clarifying question, and Adrian, if you could be very, very fast, and we'll go on. So Adrian, go ahead.
Okay, well, you may cut to this. It just was like, what took us so long to collapse with the way you described this, and why is it collapsing now and not before?
Well, actually, the banking sector has collapsed so many times. If you read the history, it's fascinating. Collapsed in 29. We had, I think, 150 banking crises worldwide in the last 50 years. It does because it's built on weak foundations, and it's basically a fractional system. So it works because people are not going to the banks to get their cash because there wouldn't be enough cash. And again, I can point you to some resources to understand that better, but maybe in the next section it will become clear as I look at the actual accountings of the banks. So let me do that, and then we'll open up for questions again. So page 24, and I've done this over dinner, so I know it's possible. Why bother with bank accounting? I'm going to show you the very simple accounting of a bank so that you understand how money is created and what is the problem and why the banking system is unstable structurally. We need to understand the bank account if we want to understand our money supply, the money creation process, and our payments of system of payments. But I don't have time to get into that last point. But let me just start very simple on page 25. And let's imagine you and a couple of friends happen to have $1 million in cash and decide to open a bank. And what you're going to do is use half of that million to buy a building, a bank building, and the other $500,000 you put in the vault of the building, and you have a nice sign saying, Bank 1. So your balance sheet at that point would look like it looks on page 25. You have the equity capital on the right-hand side, which is booked on the liability side of the balance sheet. And then on the assets, which is what the bank owns, is the bank building and the cash. It's a very simple model, I understand. But just stay with me. Next slide, the first customer arrives and deposits $200,000 in cash. And again, let's not ask how they got those $200,000 in cash. And what happens is, you see, on page 27, what's happening is that cash is not held on behalf of the depositor by the bank, but it becomes an asset of the bank. And this is something that few people understand. When you deposit cash in a bank, the ownership of that cash is transferred to the bank. It becomes a bank's asset. So you're asking, but what about the checking account? I see a checking account with $200,000. Isn't that not cash? Kind of. That is a liability of the bank. The bank creates that checking account for you, and it is a promise to make payments on your behalf by the amount of $200,000 in total if everything goes well. In other words, you are an uncollateralized creditor of the bank. And this is an important point that I will explain as we go into the troubles of the bank. And here is the other point. Let's imagine a borrower arrives and wants to borrow $300,000. Now, the understanding, which is faulty, that banks are intermediaries would suggest that the money of the depositors is taken to be lent out to the borrower. But that's not what happens. What happens is, if you look at the next slide, what the bank does, it accepts the promise to repay by the borrower as its asset and books it on the asset side of the balance sheet. And on the right-hand side, it creates a brand new checking account by typing a few numbers in a computer and credits it with $300,000. That is electronic money that the bank just created there and then. And this is how the electronic money is created in this country and, in fact, in most countries. And that's what a lot of people, including a lot of economists, don't seem quite to grasp. And if you just flip back between page 28 and 29, you see the magic of money creation in the system we have. Now, let me proceed and go to the next slide, which is basically banks actually do not hold a lot of cash in their vault, and most of the banks, especially the nationally chartered, have basically a checking account with the Federal Reserve. So let's imagine this particular case that this bank decides to deposit some of its cash with the Federal Reserve. So what happens effectively is the equivalent of what you saw when the first customers arrived depositing some money. The Federal Reserve accepts that cash as its asset and creates, out of nothing, with an accounting entry, a checking account basically for Bank 1 that contains federal funds deposits. The combination of the federal funds deposits, which now show up as an asset of Bank 1, and the cash, is what is called the reserves. And we have a fractional reserve system in this country. So what it means is that, so first let me define what reserves are. If you go on page 33, the reserves of Bank 1 at this point are $700,000, $200 in cash and $500 in federal fund deposits. Those are the reserves. The fractional reserve system simply means that banks need to have at least 10% in reserves of the demand deposits they have. Demand deposits are like the checking accounts they have. Those, remember, are liabilities of the bank, and they're called demand deposits because at any point the owners of that checking account could decide to take some money out of it. That's why it's called demand deposit. But they actually figure out that not more than 10% are needed to facilitate those transactions because most of the people leave a good chunk of their checking account money in the bank. And so the question to you is, for this particular bank that has $700,000 worth of reserves, how much money can this bank still create by lending it into existence? And if you just think about that, if $700,000 is 10% of the demand deposits, then the demand deposits can actually be $7 million. In other words, this particular bank with these reserves could create, technically, now there are other capital requirements and so on, but just to stick with the reserve requirements, could create an additional $6.5 million of additional loans. It can create $6.5 million of money, electronic money, by lending it into existence. So this brings me to slide 35 that shows you the aggregate balance sheet of the commercial banks. And this was last year, in the middle of last year. I went through the numbers from the Federal Reserve. But basically, the banks had then about, if you add demand deposits to time deposits, which both are considered fairly liquid, about $9.5 trillion of liabilities, which is the money that we use to pay each other and facilitate economic transactions. That money was created by banks making loans. And they, if you want, one way to look at that is they either monetize the loans they made, turn them into spendable IOUs of the bank, checking accounts and electronic money. Or another way of saying that is they created that money to buy themselves all those assets. It's another way of looking at that. And so what we use as money is only as good as the assets of the bank. And we got in trouble in 2007 and 2008 because so many mortgages were created of very poor quality, and they kept getting repackaged by Wall Street into mortgage-backed securities and collateralized debt obligations and so on, that at a certain point those were assets of the banks that were not worth what we thought they were worth. And so at that point we realized the whole money and banking system could collapse because our means of exchange, which are the liabilities of the bank and the electronic money that the banks created when they made loans, are only as good as the assets of the bank. And on page 36 is the Federal Reserve. Now the interesting thing about the Federal Reserve is that it can create as much money as it wants through the federal funds deposits. So they can just create, they don't have any limit. Like while banks have a limit of 10 times the amount of reserves that they hold, the reserves themselves, or the federal funds that the central bank can create, are unlimited. And that's an awesome power if you think about that. And very few people also know that it is touted in textbooks as an advantage, right? We have an independent central bank, not influenced by government control. It translates into the Federal Reserve actually being owned technically by the banks themselves. In other words, the Federal Reserve looks more like a private entity than it looks a government entity. And in fact, remember what I said about the seigniorage. The cost of creating this electronic money, whether it's in the form of federal fund deposits or the money that creates the bank, is basically zero. The cost of creating that money is just typing a number in a computer. So the question of who gets the seigniorage, who gets to benefit from the difference of the cost of creating that, which for electronic money is basically zero, and the face value of it, that for the entire banking sector, as we saw, was $9.5 trillion. And the answer to that is for the private sector mostly, and for the federal fund deposits, the Federal Reserve. And you see, the Federal Reserve notes, there are the paper money. The Federal Reserve technically pays for the printing of those notes, but then can spend them at face value. And if the Federal Reserve were really part of the government, then the government and the taxpayer would capture the seigniorage of, for example, the Federal Reserve notes of the paper money, which is what happened in England since the central bank in England was taken public again, was nationalized in 1947. So whatever paper money is issued in England basically defrays the cost of the government. It's like revenues for the government. In the United States, it's not revenue for the government. It sits on the books of the Federal Reserve, which is at the end of the day a private entity. So the key question, obviously, now you can think about that, right? Who creates the money? Mostly, we'll look at the next slide. And in fact, I realize I might not have time to go into this, but I just want to summarize on page 38. When people say the government creates money, that's only true for the coins in our pockets. And that's a tiny fraction of the money supply. The private sector creates most of the money we use. The Federal Reserve creates about 3% in the form of paper money, and then creates the federal fund deposits that are leveraged by the banking sector into our electronic money that we use. So 97% of our money supply is created by the banking sector when they make loans. And this on page 41, remember what I said, the problem with that design is that the banks decide the first use of that money. And the chart that you see on page 41 was created by the Deposit Money Institute, and they looked at money creation in the UK in the 10 years prior to the financial crisis. And what they found is that only 13% of that new money was directed to non-financial businesses. In other words, to the businesses that actually create the goods and services that we need. Most of the money was actually lent into housing. And remember, if you're lending into housing to just buy and sell an existing stock of houses as opposed to building new one, you're basically just inflating the price of those houses. And 37% was lent into financial markets. And that's part of the reason why the financial markets had seen such an appreciation in value. So that's the problem of allowing the banks to create and direct credit. And a lot of that gets directed in ways that are creating asset bubbles as opposed to create real economic activity and wealth for everybody. Now, obviously, let me see. Let me just go quickly through the next section because then we'll open up for questions. And if people want to stick around a little bit longer, I can stay as long as you want to answer questions. But I just want to say that obviously this design of the banking system is very brittle. It has collapsed many times. And I'll show you what happens when things go bad for a bank and how we have bailed out the banks from their own foolish lending. The TARP, the government bailout, and the new bailout, which would be the bail-in. I want to talk about that briefly. So page 45 is actually 46 is where I start. So this is an example of a very simple bank, and again, it's super simplified. But you have some equity in the bank. You have the liabilities of the bank in the form of checking accounts by the amount of $600,000. And then you have some loans on the asset side and some cash, and maybe a bank building. So what happens if borrower A defaults on the loan? That's on slide 47. Well, in that case, it's not too bad. The equity takes that hit. In other words, the balance sheet is called balance sheet because it needs to balance. The two sides have to balance, right? And so in that particular case, slide 48, what's happened is that the equity takes the hit. So the owners of the bank takes that loss. But what happens on page 49 if a larger loan defaults? And that is greater than the equity. That would wipe out all the equity, page 50. And again, the bank will be insolvent because its liabilities would be greater than the assets. And so the bank will fail, and by failing would jeopardize the amount of money that they have in liabilities, right, in their checking accounts. So that's exactly what happened in 2007, 2008. So if you look at page 51, we came to the rescue of the banks in various ways. The first was TARP. Remember the Trouble Asset Relief Program. The trouble assets were the CDOs and all those crappy packaged mortgages that the Wall Street created and the banks bought. And so what the government did basically was replace with good cash. There was actually borrowed cash. Remember, the government has to borrow money or get it in taxes, right? To bail out, to basically replace it with assets that were not worth that amount. And that's the only thing that made things happen. In other words, we had a transfer of wealth from the public sector to the private sector to bail the banks out from their mistakes. Now, the other maneuver, which is on page 53, is to recapitalize the banks. So the government actually obtained permission to take an equity position in a bank. In this case, they injected money in various banks, including Citibank. And the only way for that to work is for the government to overpay for the equity position in the bank. And so in other words, on slide 54, what you see is the government maybe put in $300,000 but only got $100,000 worth of equity. And this is actually a very real thing. I remember I was still in the industry at the time, and I remember the day the government injected $25 billion as a preferred non-voting equity in Citicorp, taking a tiny minority non-voting share of the equity of this huge bank. And that day, the market capitalization of Citibank was $23 billion. In other words, the government could have bought the whole thing in the open market and saved some money to boot. So again, this is a transfer of wealth from the public to the private sector. And finally, the bailout, that's interesting because the Dodd-Frank regulation that came out after the crisis, which is really not strong enough to address the next problem, but had one provision that said no more tax-funded bailouts next time the banks get in trouble because of derivatives bets. And everybody cheered and said, yay, we don't want to be on the hook for problems with the banks. Well, how are they going to fix the problem next time around? And that has been tested in Cyprus. I don't know if you know about Cyprus, but basically what happened is that they confiscated the deposits of the customers of the bank. In other words, since the customers of the bank are uncollateralized creditors of the bank, they simply transformed some of those liabilities, uncollateralized liabilities, which is some of those checking account values, into shares of a basically worthless company. And that's basically what happened. So I'm saying this because that is the likely scenario that we might encounter in the next collapse of the banking sector. Only the too big to fail banks are allowed to do that. There's a directive that was drafted by the Federal Reserve and the Bank of England, and I can share that document. You can see it. And so the globally active, strategically important financial institutions, so basically too big to fail banks, are allowed to do this confiscation, to transform uncollateralized liabilities in the form of deposits into capital Tier 1 or Tier 2 capital of the bank, which basically means into equity of the bank. And so this is important because if you have money with the large banks and you're above the $250,000 limit, some of your deposits might be at risk, and some of your favorite businesses, especially local businesses, might be exposed to this risk, and people need to know. So anyhow, just to summarize the design flaw, and then we'll see how to fix this. Actually, you probably already know, and you can read that. But on slide 60, this is also done by the Positive Money Institute. Our debt is really, our money supply is our debt. And the only way to get more money in circulation right now is to increase debt. We're trying to, the quantitative easing and so on is trying to encourage people to borrow more because that's what it takes to get more money into the economy. What we need is really on page 61. We need less debt and more money. And then can be done basically by taking the steps on page 62. And I understand some people think these are unrealistic, but once you see a crisis happening, then we have a chance to move. We need to remove the power of the private banks to create money. Return that power to a transparent and accountable process that decides how much money to create and when, as long as inflation is low, and create money free of debt, and make sure that the money goes into the real economy instead of the financial market. And this was the third video that I shared. The path forward is we need to, page 63, build understanding and awareness. The public banking movement is a great movement to build upon. And we need to nationalize the too big to fail banks at the next crash and run them as utilities for the benefits of the public. If we, the public, have to take on the risk of them failing, then we should operate them for our benefit collectively. And finally, we need to eventually nationalize the Federal Reserve, make it a branch of the U.S. Treasury. And this, by the way, was proposed. There is a 20-page law that was proposed in 2011 by Dennis Kucinich called H.R. 2990 that would do exactly that. Basically, it would return to a sane monetary system where the money is created debt-free, goes into the real economy, and there is a commission that determines how much money to create every time, and then the government can obviously allocate that. But these are the possibilities. Now we talked about once we do that, once we reclaim the power to create money as a government function in the interest of the public as a whole and society as a whole, then these are the things that can happen on page 64. We can reduce the power of the private banks and money on government, remove the artificial scarcity of money, and we could, for example, have the government as the employer of last resort. There are a lot of people that are unemployed. There is so much work that we need to get done, and the private sector is not willing to come up with the jobs. So we should have the government issue debt-free money and spend it by hiring the people that want to work doing the work we need to do. So anyhow, I will open up for questions. I know I bombarded you with a lot of information, and a lot of this content is new to a lot of you, but I felt that we do need to become conversant and knowledgeable about this because we need to build basically a political movement for the next time we have a chance to reform it.
Marco, thank you. What a wonderful wealth of knowledge you have. So if you have questions, press 1 on your keypad, and we'll go to them now. I see that some of you have pressed 5, so that's fine too. I can take those. Jane, we'll start with you.
Okay, hi. I just wanted to say thank you for such a coherent presentation, but I also have a question about fees that banks are increasingly charging for things like overdrafts, and whether you see that as an additional layer of lending money into existence. Just your comments about that.
Right. So that's a great question. The old banking model was actually based on interest rate spreads. So if you look at the two sides of the balance sheet, right, the banks need to finance the attraction of the capital that they get in. So in other words, saving accounts, they might pay a little interest. If you go back like maybe 30 years ago, right, you would be paid 1 or 2% on your checking account, and then they would make lending for mortgages at, let's say, 12 or 15%. That difference in interest was what the bank earned, and that also needed to cover any defaults that they might have on their asset side. So they need to cover the defaults, the bad loans that they make, and then the rest is to pay for the operation of the bank. Now we have exceptionally low interest rates, and this has squeezed that business model almost out of existence. Now banks lend for 30 years mortgages at 5 or 6%. That's a very narrow margin, and of course they pay almost nothing on deposit, in fact 0, or very little in CDs. If you buy a CD of a bank, they pay less than 1%, or 20 basis points, 30 basis points, and so on. So they had to find a different way to generate revenues. And what they're doing now more and more is to slap fees on whatever you do. If there's an overdraft or you need to use the ATM somewhere else and so on. So they went from a model where they were deriving most of their income from the interest rate spread between their cost of capital and what they were lending it out to a model where they do two things. One is they increase their fees, and the other thing that the big banks are doing is they're doing proprietary trading, and they are basically betting, now that the Glass-Steagall Act was removed, thanks to the Financial Modernization Act of 1999 signed by President Clinton, now investment banks, trading activities for the bank and so on are commingled with the commercial operations. And so the large banks now are engaged in all sorts of investment and trading activities that generate returns for the bank. So it doesn't create new money per se, but it's the way the business model has evolved. And the way we need to go to basically in the new model is the banks would basically just pay, charge a fee for managing your payments. But there would be no risk associated with that anymore because those will be basically central bank reserves. And then for people that want to do investing, they know that they provide the capital to the banks, and that capital is at risk. And if the bank has a problem, the investors will share part of the loss. But that would not threaten the whole system of payments at the national level.
Miles, you're up next. Go ahead.
Hi, Marco. This is Miles with Albany Arts Gallery and Transition Albany. I had a question about Baybucks, which is a barter bank where the currency is created by the exchange of goods and services to other small businesses. I wanted to know if you thought that this was a useful tool and how you would improve upon it.
Yes, that's a great question. So first of all, Baybucks is like an electronic barter system. At this point, business to business, and it's in the Bay Area. But there are a number of them. They're called LETs. And they're a great way of supplementing the money that is scarce because of design, right? So anything you can do in terms of local currencies is great. It does not solve the problem with the overhang of debt, because all the debt we have, both at the national and at the personal level, is denominated in this currency, which is created in this very faulty way, and there's no way out of that. But I would say because of the way the current money system is designed, we know that money is scarce. We don't have enough money in circulation to facilitate the economic transaction we need and could be possible, and therefore local alternative currencies. And I'm a big fan of LET system like Baybucks. Because they allow for transactions to occur that would not otherwise occur if we didn't have that. So I like it a lot, and it's fairly standard. So I don't think there is an issue with the design of the Baybucks. They've been working around the world for at least 30 years. So I would definitely encourage everybody to find out.
Let's move on to someone else at this point. Miles, we can come back to you. Gina, go ahead.
Hi, yes, thank you. A couple of questions. Could you comment a little bit on credit unions, and do they follow the same model of money creation as the rest of the banking system, number one? And number two, is there a written document that you can refer us to where we can really try to absorb the accounting issues that you went through with the banks, trying to explain that?
Yes. Yes. So the first question is about the credit unions, and I'm a big fan of credit unions. They, the system is the same. Even in the case of a public bank, for example, the system as it is designed right now is the same. In other words, when a credit union or even a public bank makes a loan, it creates the electronic money corresponding to that. The credit unions, I believe, have a higher reserve requirement, so they're a little bit safe, and also they're really run in the benefits for the benefits of the community itself. In other words, they're not abusing that awesome power of being able to create and leverage the deposits into additional loans. So I would say, and remember, those are democratically owned institutions, one member, one vote, and the small regional banks and the credit union are doing the majority of the lending to the local economy. They only have about 20% of the assets, 21% of the assets in the country, and they make more than 50% of the loans. So just transferring money from the large banks to the regional and credit unions has the effect of amplifying the lending in your community and the financing of your little operations. Now, to understand the accounting, I would say the best book you can get is Modernizing Money. It's kind of the college, maybe junior college or high school level. It's very approachable, and it explains all that most of the theory that I presented in a way that is very clear. I can also point you to, if you come to my website and you look at curriculum and go into money and banking, that page has a number of resources that you can click on, especially some tutorial videos by the Positive Money Institute in the UK. They've done a very good job at disseminating these concepts.
And Marco, tell us your website again too, please.
Yeah, so EK4T.com, EK for T, which stands for Essential Knowledge for Transition.com, and you'll find information there.
And Jim Zach, go ahead.
Hi, I have a question about previous incarnations of U.S. central banks. I know there was one around Andrew Jackson's presidency, but could you tell us what made these central banks fail and led to the 1903 secretive creation of the Fed?
1913, yeah. The Federal Reserve Act was passed in, I think, December 23rd, 1913, so we just passed 100 years. I would say the best book to read about that would be Ellen Brown, The Web of Debt. It reads like a crime novel, except is the history of the financial system, and it shows the ins and outs of the first Bank of the United States, how that the charter of that was not renewed, and then the second attempt, and finally the creation of the Federal Reserve in 1913. So that is a great book to check out. It's called The Web of Debt by Ellen Brown, also the founder of the Public Banking Institute. And there is an interesting documentary. You'll find it on my resources on that page on my website called The Secret of Oz, which is a documentary from 2009 telling kind of the financial history of money and banking in this country.
Diane Fleming, go ahead.
Yes, hello. Thank you very much for a most cogent and easy to understand, particularly if you had banking experience, and this is the first time, quite frankly, that some of the complex issues have now been, for the first time, understood by myself. So thank you very much. And I can appreciate that those without financial background, it would be a little bit of struggle, but quite frankly, I think reading through this material a couple of times and associating it with financial information that you've already personalized in your lives, namely you obtain a bank loan, you're required to submit a financial statement. But if you compared these very simplified models with constructs that you're familiar with in your own work experience, I think that'll help. Books, I tend to think it makes it more and more complicated, because we need just to understand that this revamping our financial system forces us to utilize or scarce resources in a more efficient manner, so that what we're experiencing now, the collapse of the financial markets, will be a thing that it would disappear, because the system would be more in harmony with your system hierarchy and not continually out of sync because of politics, because of externalities, etc. So that the pricing structure would be what it should be and become as ideal as it could possibly be in a democratic society.
Right. Yeah, well said. And, actually interesting, it might be easier for people that don't have banking backgrounds or have studied economics like me, because they then wouldn't need to unlearn what is not quite correct. You see what I mean? Sometimes people that are not steeped into a particular narrative have a higher, an easier time to grasp how things actually work. And that's why I'm doing this. I'm trying to simplify, but not too much, obviously, but to show that it's actually not that complicated to understand the basic design of the system. And now, of course, I'm not pretending to know, all aspects and complexity, but the very simple design is easily understood, and that's what people need to get.
Before we go to our next callers, our teleseminars are generally 75 minutes, which we're just a couple of minutes over that now. So can appreciate that a number of you might need to roll off the call, and I will send the recording out to those of you that have registered for the call, so you'll have that. And Marco has agreed to stay on longer. So we will take a few more calls for those of you that still have some questions. Kevin, you're next.
Hi, I'm late to the call, but I'm very interested in the topic, and particularly because I've been lately talking to a variety of people about cryptocurrencies, and I apologize if this was addressed earlier in the call, but I just went through the slideshow and saw that you do mention fiat currencies and other forms of currencies. Can you talk a little bit about, not necessarily about Bitcoin per se, but about the ideas of cryptocurrencies, new forms of currencies, and how they relate to your concept of nationalizing the infrastructure of the U.S. banking system. And again, I apologize, I'm early to all this stuff, so I'm just beginning some research.
Right. Yeah, so, and again, I don't know if you're familiar with the work of Bernard Lietaer, or Lietaer. I can't quite know how to pronounce his last name, but at the end of the day, if you look at a system is resilient when it has the right balance between efficiency and diversity. And so if you look at our monetary system, is very efficient. There is one currency and we do everything through it, mostly, the US dollar. The problem is it's poorly designed, it's prone to crisis, and every time there is a collapse in that system, the economy and society suffers a lot. Eventually we'll need to get to a place where we have a large diversity of currencies that can help us do various things. And so I am in favor of alternative currencies as long as they're well designed. And there's a good book by Tom Greco called The End of Money and the Future of Civilization, where he basically goes through what are the design criteria for an alternative or complementary currency that would make it successful. So in terms of the cryptocurrencies, of course, I'm curious and interested in what technology can bring in terms of alternative currencies. For Bitcoin itself, there's a lot of interest in it because the value of the Bitcoin has gone through the roof. So a couple of years ago, with a few cents per dollar, per Bitcoin. Last year in June was $100, and then went up to more than 1,000. The issue I have with the Bitcoin is that it is easily manipulable. I wouldn't be surprised if some of the big boys are playing, with a spare $1 billion and milking this thing on the way out and down. But it is an interesting concept. The idea of the anonymous transaction is a little bit, an issue, right? Some people say, yeah, we want to have the privacy that we don't seem to have in any other aspect of our life. And other people say, well, if we need to do something collectively and we need to finance that maybe through taxes, then everybody would need to pitch in and do their fair share. So, there are various arguments about that. But in general, I would say the direction towards a more diverse ecosystem of currencies, including local currencies and cryptocurrency, is a good one. But again, I have some reservations about Bitcoin being the one that we need to focus on.
Thank you for that, Marco. Janice Lynn, and then we'll go to some of you who've already asked questions and wrap it up soon. So Janice, go ahead.
I just have a question. You mentioned that the importance of investing in the real economy. So what kinds of investments would those be exactly?
Well, the real economy, okay, what I'm saying is that when banks create money, they can either lend it to, let's say, hedge funds or private equity guys to do financial speculation. They could lend it into mortgages, right, which is still not creating mostly new goods and services or new houses. And very little goes into lending to businesses that are trying to create goods and services. So that's what I refer to when I'm saying make sure that the money that is created goes into the real economy, means lending it to people that are actually creating goods and services. And that's what's happening very minimally right now, especially the large banks now. They're not really lending a lot to especially small businesses. So the real economy is the one that creates goods and services for society, as opposed to shuffling computer numbers from one computer to the other, and trading activities and financial assets changing hands.
Great, thank you for that. Stuart Scott?
Yes, thank you very much. I have two questions, and I'm willing to discuss either back channel by email. I don't want to hog the microphone, so to speak, but let me pose them both. One, if one had a influence in a small government in a developing country, which I arguably do, would it be possible, and how would you go about talking them into a voluntary change from this central bank road to disaster kind of banking system? That's the first question. Second question, since my interest in money and the problems with money is couched in the larger problem that I'm primarily interested in, which is the tanking of our ecological systems, most notably the climate system. And there's a clear causality in my mind and the minds of many people that this is partly caused by the explosive growth of the money system, which basically is chewing up the resources of the planet as fast as possible and throwing them away in the service of creating more money for the exponentially growing economic system. In certain things you've said, you seem to say, well, we can just do the same thing but do it more righteously if the governments own the money system and not the private banking system, and that we should again, I want to get your opinion on whether or not we just need to abandon this idea that a healthy economy is a growing economy in order to save our children.
Those are two excellent questions. So the first one is actually there is a concrete possibility that Scotland will have a referendum to separate from England. And because the Positive Money Institute is based in England, they had the chance to talk to a number of politicians there, and they even created I think a 70-page proposal for how an independent Scotland could set up its money system in the right way. So there is that proposal. I can, if you contact me later, I'll send you a copy of it. And that would be kind of cool, right, to have a country in Europe actually take that step. Iceland could also be a possibility because they have their own currency, unlike the other European nations that are kind of tied to the euro is like a foreign currency for a lot of European countries, because they don't control the quantities, and the central bank of Europe is calling the shots. So I would say definitely keeping an eye on Scotland and Iceland. It's an interesting one. Your second question is, I totally agree with you. In fact, I will talk about the economic system from the perspective of ecological economics. We have to recognize that the size of the economy has to be small enough to fit the renewable resource extraction from the ecosystem and its absorptive capacity. And that is not done right now. Part of it is because of the exponential growth that is required by this house of cards of the money banking system that requires this continuous growth to paper up the fact that nobody creates the money for the interests. So when we remove that imperative for the money supply and therefore the economy to grow, we can get to a steady state economy. And we also need to realize that the growth has to be steady state for the material throughput. So not all growth is bad. For example, let me give you an example. If we decide to double the teachers in this country and pay them twice as much, which would be great for educating the young and society as a whole, and the government creates the money to pay them, that is actually a quadrupling of the growth of the educational sector, if you want. So we've seen growth there that is okay because it does not require throughput of material. So we can grow in terms of development of well-being and doing things better without having to grow the material throughput through the economy. And so again, we have to distinguish the type of growth, but what we need to do is really rein in the growth in the throughput of material and energy and expand the growth in the things that do not require that.
Thank you, Marco. We have Mark Heffernan next.
Yes, thank you. It seems to me that the last question that the gentleman just asked with regard to how do we take care of the things that need to be taken care of while we're trying to do so with the present monetary system, one of the questions that keeps coming up is why is there this focus on the money itself? Oftentimes the economy is described as the money instead of the activity that it could support, and yet you've pointed out righteously that if money systems were actually considered to be utilities, then the utilitarian function of money could be focused on. The problem is that if we retain the idea that money being made off of money by way of interest is a legitimate understanding of money, it can only do exactly what it's been doing, which is to drive the focus in the wrong direction, to the money itself directly for trying to make money from money. The interest process then can only do what it presently does, which is to take the volume of money that should be in circulation and remove it so there won't be enough money in circulation. And so the definition of what is usury, what is wrong with the money system itself, especially if we leave interest in play and try to yet maintain this system as utilitarian, it becomes impossible. So the question that I run into all the time is how to get people away from focusing on money, and especially trying to get them to not focus on how do I make money off of money, when in fact if it's supposed to be a utility, you wouldn't try to ask inches or gallons or millimeters or any other measuring device to create itself. So the focus of
money itself and the loss of focus on and a full definition of what is usury, why is interest banned, and what are the dynamics of usury and why it's banned and why it actually gets in the way of what we're trying to do with this thing called money. That seems to be one of the problems, and that's one of the problems I thought was still the case even with the H.R. 2990 bill, because if the money is spent into existence, but people can still charge interest, the reduction of the volume of money in circulation will require new creation ad infinitum.
Right. Yeah. Okay. Well, let me try to attempt an answer to your question, which is an excellent question, and it's almost existential, right? Why we focus so much on money is because it's scarce. So imagine you're building a house, and the tools that you need to build a house are not sufficient. So you only have a hammer, So we would all be worrying about hammers. Where is the hammer? Who has it now? Where it's going, right? When we shouldn't really be worrying about that. We should worry about what type of house we're building, how we're designing it. So part of the reason why we're so focused on money is because it is scarce. Your question of your point is very good, which is as long as we have an interest, and interest is kind of makes sense from an economic standpoint, is a compensation for the deferment of consumption. If you are taking money from someone as a loan, they give up the use of that money for a certain period of time, and that there's an argument to be made that they should be compensated for not having the use of that money while you use it. There is also the risk that you might not return it. So the interest is covering the potential risk that they might lose that money because you don't return it to them. So interest per se are not necessarily a bad idea, but in aggregate you're right that if money demands an interest, then that itself would cause the money to expand. And so I would say H.R. 2990 is the preliminary step. And the ultimate step, if we are to make this great turning and live in balance with this planet and this ecosystem, we would have to go to a demurrage currency at the end of the day, which is a currency that loses value over time, that has a negative interest, like everything in nature eventually is composted and loses, there is birth and deaths, right? So that's part of nothing lasts forever in nature. And so in a demurrage situation where you have a negative interest rate, an investment can be done at zero interest. And so this would allow the proper amount of money to remain the same through investments, or start shrinking as everything in nature dies and withers with it. So, but that's a bigger discussion that we can have now. But you're pointing the finger in the right direction, which is even a fixed monetary system still has the problem with the positive interest and the continuous growth that derives from it.
Wow. Okay, Miles, back to you.
Hi. So I wanted to clarify your stance on how you think the monetary system could be best managed. Do you think it should be localized for small communities so to enhance diversity and competition for the best system, or do you see the power residing in like the current government system or something larger like a World Bank? What is your apex?
Right. Well, there is a big question, and that is, can we have a representative democracy at the continental scale? Right. So that is a big question. So, and that's something that we need to tackle. We know that we currently have a money system, the dollar, that is a national currency in a nation that is as big as a continent. And we have a problem with that, and we need to fix it because it's going to whack us many times. But then even after we fix it, the question is, do we want to have a predominant huge currency control at the national level with the potential of being influenced by power brokers in the center of power, let's say Washington, D.C., and so on? And that is a big question. And I would say eventually I would love to see more and more local currencies displacing over time the use of the national currency. so that that becomes less important over time. So that's my take, is that we first have to fix the current system because all our debts are denominated in that system and we can repay them. But then after we've done that, we really need to start developing, or in parallel, develop the new currencies that currently are compensating for the scarcity of the national currency, and eventually, hopefully, will take more and more predominance and importance.
Marco, thank you so much. This has been fantastic. You've got so much knowledge.